We're analyzing Federal Realty Investment Trust, ticker symbol FRT. This stock has one of the highest dividend yields in the S&P 500. We want to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Federal Realty. There will be a key bonus metric along the way that might be the tipping point when analyzing Federal Realty for your portfolio. Before we get into these valuable metrics, let's understand Federal Realty's stock performance. So currently the business is trading for $92.51 per share. Over the past year, their stock price is down 21.5%. Over the last 5 years, the business's stock price is down 19% overall. Over the last 10 years, their stock price is down 12% overall. However, going back prior to the global financial crisis, over the last 18 years, Federal Realty has compounded their stock price at just under 4% annually. The company is a real estate investment trust or a REIT, so they have to pay out 90% of their earnings as dividends to shareholders. And so the business has a sizable dividend yield in addition to this. Currently, they pay out a 4.65% dividend yield, and their average dividend yield throughout this time frame would be in addition to these compounded annual returns. Federal Realty is down $30 from their 52-week high. The company is just $6 above their 52-week low. Only 2% of their shares outstanding are sold short. This is a large business. They have a $7.5 billion market cap. For more background about the business, Federal Realty Investment Trust is a shopping center-focused retail real estate investment trust that owns high-quality properties in 8 of the largest metropolitan markets. Its portfolio includes an interest in 103 properties, which includes 25.8 million square feet of retail space and over 2,900 multifamily units. Federal's retail portfolio includes grocery-anchored centers, super-regional centers, power centers, and mixed-use urban centers. Federal Realty has focused on owning assets in highly desirable areas with significant growth, and as a result, the average population density and average median household income are higher for its portfolios than for any other retail REIT. Federal Realty has increased its quarterly dividends to shareholders for 54 consecutive years, which is the longest record in the real estate investment trust industry. As mentioned, the company is a member of the S&P 500, and it was founded in 1962. So starting things off with metric number 1, we want their average return on equity over the last 5 years to be above 12%. This is because the average REIT earns about a 6% return on equity, so by asking for double here, we can potentially build in some margin of safety for ourselves based off the quality of the business being about twice as good as average. Federal Realty saw the return on equity decrease pretty significantly in 2020. Since then, it has been rebounding. However, when we average this out, the company is earning just about a 10% return on equity. So while that is better than a typical REIT, that's below that benchmark we were looking for, and so this is an X on metric number 1. Next, for metric number 2, we're taking an overview of the growth of their business. So here we're looking for revenue, net income, and cash from operations growth over the last 5 years. This metric is all or nothing in nature. Either all 3 of these will be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time frame, Federal Realty has grown their revenues by 18%, their earnings have increased by 59%, and their cash from operations are just very slightly and very marginally up. They're up just a little more than $70,000 on a base of about $515 million. So that's very slight growth, but that is growth nonetheless. With all 3 of these being up here, this is our first check of the day on metric number 2. Next, for metric number 3, we're taking the perspective of an individual shareholder in the business by looking at Federal Realty on a per-share basis. So we're looking for earnings per share growth over the last 5 years for the business. As we learned in our previous metric, their earnings have grown by 59% over this time frame. Because REITs tend to be externally funded by either adding on debt or by issuing shares, Federal Realty has diluted existing shareholders by about 10% over this time frame. Ideally, we want businesses to be keeping their shares outstanding flat, or better yet, buying back their stock when it's trading for below an intrinsic value of the business and it looks like an attractive use of the company's capital. Even still, their earnings growth has outpaced their shareholder dilution, and this is a check here on metric number 3. Next, for metric number 4, we're looking for free cash flow per share growth for Realty Trust over the last 5 years. So with their cash flows just being marginally up over this period, their 10% shareholder dilution is going to be outpacing their marginal growth in their cash flows, meaning that this gives us the opposite result from the previous metric we looked at. This is an X here on metric number 4, and recapping where we stand currently, through our first 4 metrics, we have 2 checks and 2 X's for Federal Realty. Next, for metric number 5, here we're evaluating how the business is using debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of cash from operations that the business has produced over their last 5 years. So Federal Realty has steadily increased their net debt position throughout this time. They've added on more than $1 billion in net debt in the last 5 years alone, and currently the business has about $4.4 billion worth of net debt. Over these last 5 years, the company has produced about $2.3 billion worth of cash from operations. That's coming in well short of their current net debt position, and so this is an X on metric number 5. As has been the case with many of the REITs that we've looked at, this may or may not be a potential concern here. Because real estate assets are typically able to be more highly levered than some other types of assets, if this is a potential concern for you, you can dig into the company's filings to understand their debt profile in more depth. The big metric of them all, metric number 6, we want their average cash from operations to their total enterprise value to give us a yield that's above 5%. If this is the case, this may offer a slight risk premium to the yield of the 10-year treasury, and it may offer a reasonable starting point for evaluation of Federal Realty. So we're using their total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the business that's more similar to as if Federal Realty were a private company. In our previous metric, we learned that the business has produced $2.3 billion of cash from operations over the last 5 years, meaning that in an average year, the company earns about $470 million in cash from operations. When we divide their $470 million of their cash from operations by their $12.3 billion total enterprise value, that gives us about a 3.8% average cash from operations to enterprise value yield for the business. So that would be about in line with the yield of the 10-year treasury. However, that's down from that 5% risk premium we'd be seeking. And so this is an X here on metric number 6. The company has produced $517 million in cash from operations over their most recent fiscal year. So when we divide that by their total enterprise value, that gives us about a 4.2% current cash from operations to enterprise value yield for Federal Realty. So that would also be just slightly above the yield of the 10-year treasury, but again below that 5% risk premium as well. With both of these being below that risk premium, this doesn't necessarily mean that you're going to toss this business out. This isn't a buy or sell recommendation of any security, and you'll want to stick around as we perform a discounted cash flow analysis of Federal Realty to come to a more concrete estimate for its intrinsic value. Before we get to that, let's cover our bonus metric. So as our bonus, here we're looking at Federal Realty's dividend profile. So the company currently pays out one of the highest dividend yields in the S&P 500. They have a 4.65% dividend yield, which is well above the yield that you'd be receiving from an S&P 500 ETF. However, people make mistakes all the time by blindly chasing dividends, so it's important to stop and look at the underlying fundamentals of a business to see whether their dividends are well supported or not. Federal Realty has been able to support their dividends with their cash flows in 4 of the last 5 years. 2020 was the only exception. The company has grown their dividend payouts per share in all 5 of these years, as they have for more than 50 years. However, the company's cash flows are down over the same time frame. They have rebounded since 2020, however, meaning that the company has been able to support their dividends using their cash flows since 2020. It would seem like Federal Realty's dividend is still well supported by their cash flows. 2 things that you'll want to keep in mind here are a decrease in the business's cash flows over the last 5 years and a growing debt position. That could potentially put some pressure on their dividends, so that's something that you would just want to be mindful of here. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Federal Realty Investment Trust, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for the business. So a discounted cash flow model is based off a business's predictability, and it's just like any other model in any other discipline, its outputs will be sensitive to its inputs. Here we're starting with an average of Federal Realty's free cash flows over their past 5 years to give us a more normalized perspective of the business's abilities to produce free cash flows. Then we're projecting these out into the future using historical growth assumptions for the business. So it's up to you to do your own homework here to determine whether or not these will be accurate and applicable going forward to give us a baseline projected estimate for Federal Realty. If we assume that the business grows their free cash flows at a rate of 3% annually for the next 10 years, then that those free cash flows grow at a rate of 2% annually for the 10 years out after that. If we add in the company's tangible book value, which gives us an estimate of the company's net worth, and we were ideally seeking a 15% rate of return from Federal Realty, then it looks like at today's valuations of the business that a potential fair value for Federal Realty is around $73 per share. That would be about $20 below the company's current stock price, which is also pretty far below the company's 52-week lows. Please be mindful of a couple key points here. One is that the business has tended to be a moderately predictable company in its past. However, that's not a guarantee going forward for the company, and so that's subject to change. We would not be doubly counting the business's dividend yield of 4.65%, so that would be included in this 15% rate of return. And please be mindful that this type of analysis is not financial advice and it's not a buy or sell recommendation of any security. Before considering any potential investment decision, please consult with your financial advisor. So in just a minute, we'll get to our final rating for Federal Realty, but we have to address something first. What are some of the qualitative aspects of this business? Starting with some of the key qualitative aspects supporting a potential long thesis for Federal Realty. Number one, Federal Realty continues to sign new leases at robust double-digit spreads, suggesting solid internal growth prospects upon lease expiration. Number two, Federal Realty could benefit as the U.S. cuts its physical retail presence, attracting quality tenants to its properties as inferior centers go under. And number three, Federal Realty reports peer-leading population density and annual household income in proximity to its centers, providing a strong demographic base for its tenants. Then for some of the key qualitative aspects supporting a potential short thesis of the business. Number one, if consumers forced to purchase goods online permanently change their behavior to favor e-commerce and avoid public places, then longer-term sales growth could suffer. Number two, retailers are becoming more conservative in expanding their physical store presence. And number three, Federal's development pipeline is focused on a few large mixed-use projects, which exposes the company to risk from any of these particular projects failing and also increases exposure to real estate segments beyond its traditional retail focus. So there you have it for a balanced perspective of some of the qualitative aspects of the business. Now it's time for our final rating of Federal Realty. In analyzing Federal Realty Investment Trust, ticker symbol FRT, we learned that the business earns above average returns on equity, but just slightly below the benchmark we're looking for. The company has grown their revenues, earnings, and cash from operations over the last 5 years. However, they have tacked on more debt, and they've also diluted existing shareholders by about 10% because this business has been primarily externally funded. It doesn't look like their cash from operations would be able to support their current debt loads, and on both a current and an average basis of their cash from operations to their enterprise value yield, while those yields were about in line with the yield of the 10-year treasury, they were below that risk premium we'd ideally be looking for. The company has been able to support their above average dividend payouts in 4 of the past 5 years, with 2020 being the exception, and the business has raised their dividend for more than 50 consecutive years. And as a member of the S&P 500, this means Federal Realty is a Dividend King. When we performed a discounted cash flow analysis, if you believe those historical growth assumptions about Federal Realty, and you've done the work to validate those, then if you were seeking a 15% rate of return from the business at today's valuations of the company, it looks like a potential fair value for the business is right around $73 per share. Again, that's $20 below the company's current stock price, and the business was last at those levels in November of 2020. So you would just want to be patient here. It's worth reiterating this analysis isn't financial advice and it's not a buy or sell recommendation of any security. Before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. And instead, this analysis serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Federal Realty. So based off all the factors we saw in our analysis today, it looks like the company is a weak candidate in terms of its attractiveness for further research. That isn't to discourage you if you're potentially interested in this business, but today it doesn't look like a screaming candidate like some of the other businesses we've researched. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Federal Realty with me, and have a great day.